Hello. Welcome, friends, to Alpha Beta Soup. I'm TXMC. In the previous video, we talked about what defines an official recession in the US. There isn't an actual definition, but there's a group called the NBER who is officially tasked with dating recessions. We looked at the indicators that they have said are important to them. Things like employment, industrial production, retail and wholesale sales, consumption, and personal income. We looked at the sequencing of these metrics, which of them turned down before others, and we came away with some interesting findings. We found that there is a cyclicality to it. There are certain parts of the economy that lead other parts. But we also know that these 7 metrics don't tell the entire story of the economy. They also aren't the only things that we can use to assess where we are in the business cycle. So what I've really wanted to do is to try to profile a downturn. I want to understand what all tends to happen, which metrics slow down before other ones. I wanted to know, is there a consistency? Even though each era is a little different and has its own footprint, is there still something about all of them that is similar, that we can take away and look for, almost like a skeleton key? So we've got the metrics that the NBER finds important, but we need to add a few other ones. We'll start with the yield curve. You looked at this chart in one of the previous videos. I don't remember which one, but the yield curve is one of the most reliable indicators we have for assessing where the market is going and the economy is going. Every time it inverts, it happens before a recession. Going back to 1968, every time this has inverted, it's done so before a recession, including right here, though you can barely see it. Now, we do have recessions without yield curves inverting. If you go back before this part of the series here, during the 1940s and 50s, the yield curve was locked in place by the Fed and the Treasury, who were trying to work off the massive government debt from World War II. So we ran yield curve control, and the yield curve could not invert for over a decade. But we still had recessions. But since then, every time it does invert, it means recession, and including COVID, which everyone felt like was a surprise and was an artificial shock. There were things about the economy that were telling us we were due for some kind of downturn. We were due for a recession because the yield curve inverted in 2019. So this is something important for us to use. And if we're going to profile a downturn, this needs to be a part of it. Something else that we need to include is probably the manufacturing PMI. So the Institute for Supply Management does this manufacturing PMI survey. They've been doing it since the middle of last century. They also have a services sector one that they've been doing since the 90s, but this is manufacturing here. Manufacturing leads the economy. It's the goods sector of the economy. This is a survey. They ask a bunch of different businesses what they think about their business outlook. How's business? How are inventories? How are new orders? How are backlogs? Are you planning to hire anyone? How are prices? Things like that. And they combine all of it into a diffusion index right here. When it's above 50, particularly when it's trending higher, that's a good thing. Business outlook is positive. When it rolls over, sentiment is starting to change. When it falls below 50, less than half of the respondents are giving positive outlooks. So the PMIs pretty consistently follow the economy. There are some fake outs. There's some periods of time where it dips below 50 and we don't get a recession. Here, this is actually one of the soft landings. This was in the economy slowed down during Greenspan's era when he was head of the Fed, and we did not incur a recession. Back here in 1966-67, this was another one of the big soft landings. So there's a couple of fake outs, but for the most part, when it contracts, particularly when it contracts really very deeply, that tends to align with recessions. Additionally, manufacturing PMIs have a close relationship with the stock market, which makes them even more important for us to look at. Right here in black is the PMI, and in blue is the year-over-year percent change of the S&P on a monthly basis. Note that they follow each other really closely. And in fact, this is true. I can go all the way back to like the 50s and the 80s. It's still true back then. So this is something important for us to watch. They've always had a close relationship with each other. I don't think a lot of people understand that. And this was another view I made when I was studying the viability of PMIs. Up here at the top, in red is the PMI, the same line we have here in black. That's in red up here. And in green next to it, greenish blue, is the new orders component of PMIs, right? So you get new orders to create products for your customers. So new orders tends to lead the manufacturing sector, and when new orders softens, that flows through into the actual production of goods. And if it continues to stay soft and it doesn't expand, then that really starts to bring down that part of the economy. So new orders is important to watch, and I've got it up here. What I've got here in the middle, this was just me showing what the PMI is at the beginning of every one of the recessions. And you can see that in almost all instances, this, it is in contraction. It's below 50, which is this line here. There were a couple times it was above. 1969, it was 52. 1973, it was at 68. This was one of the hottest economies we ever had going into a recession. But in almost all these other instances, with the exception of COVID, which was right at 50, all these other instances, it was in contraction. And in most of them, it was below 47. Not even 50, but down below 47. It is pretty reliable that it is deep in contraction at the start of recessions. And then I was wondering, does it go below 47 when we don't have recessions? Just kind of out of curiosity. So down here, I decided to print the PMIs when it's below 47. It only shows up when it's below 47 down here at the bottom. And you'll see most of the time it is appearing around recessions, these gray bars, but there are some instances when it doesn't. Here in 1950. Now this is during the Korean War. So who really knows all the distortion aspects going on with the PMIs back here in the middle 50s. But here in the 60s, this was one of our soft landings. Right here in 95, this was another one of our soft landings. But all these other instances, for the most part, it's during recessions. So that just kind of helps to corroborate that the PMI is important. And when it's in contraction, particularly when it's below 47, that usually means recession. And just as an addendum, as a side note, PMI today, 46.9. It is below 47. Take that for what it's worth. But we've established PMIs are important. So yield curve, important. PMIs, important. What about the housing market? Up here at the top, we've got housing permits. Now, this is one of the first parts of the housing market, right? You get approved for construction and then you start construction. So the permits happen first and they are very cyclical. They oscillate higher and then they decline for long periods of time and we have recessions over and over and over again. And sometimes it can decline for years at a time. Housing permits peaked in late 2005. The recession didn't start until the end of 2007. Same thing back here in the 70s. Housing permits peaked in 1972 and the recession didn't begin for a year. But it doesn't always mean that the peak of housing is the beginning of a recession. You can see, you can kind of plod along for long periods of time. But usually when it gets deep into drawdown from its peak, we're at or near a recession. And it is worth pointing out that today, housing has drawn down quite a bit. The peak of permits was December 2021, and today we're about 27% down from the high on housing permits. These are the drawdown figures in all the previous recessions. Where did I say we're at? We're at 27%. Well, a whole lot of these are actually lower than that, 40, 35, 43. So maybe housing has a bit further down to go, and maybe that means we're not quite to the recession yet. Hard to really know. This one isn't quite as consistent as this one is back here as the PMIs, which are pretty much always at about 47. But alas, it does appear that housing permits consistently downtrend into an economic slowdown. So I think it's important that we at least consider it in our framework. So we've got permits, we've got PMIs, we've got the yield curve, we've got all the metrics that the NBER decides to look at. There's also some other things like the policy of the Fed itself, whether they are raising rates, whether they are lowering them, when that began and when it ended, where CPI is. There's a lot of other things that we can fold into our database, and I have done that. I spent many months doing this. It's fun for me to do this because then I have a big data set that I can go in and play with and make charts with. So I've actually been having a blast creating this. And so what I want to look at now that we've established some things that are important to us, I want to show you the normal sequence of events that these things play out in. I'll show you a visual of that, and then we'll talk about some of the quirks of some of these things and what they may mean for us today. So we've got all these different events, and when we know the dates of all of them, we can then establish the sequence that they happen in, and we can look at a big timeline of all of them. So all those events that we just looked at on my spreadsheet, they're all over here, right? They all have their own little colors, and we've got the peaks and the troughs and the start and the end of all of them, of new orders, of PMIs, of incomes, of real sales, of unemployment, of the easing and the tightening of the Fed, of the recession itself, of the peak and trough of CPI, when new orders from PMIs both contract and come out of contraction, when the PMIs themselves do it, when they peak and when they trough. Got it all, guys. Because I'm a degenerate, because this is fun for me. And when we put them all into a big timeline like this, we can then get an average sequence of events. And that looks like this. Now, this number over here is not very relevant. What is relevant is the actual order of events. Now, some of these things down here at the bottom, these are the end of the business cycle, right? These are the lows of all of these things, or the highs in the case of unemployment. And this is the end of the business cycle. In this part of the cycle here, this is the recession itself. This is when unemployment Unemployment has already begun to spike. It's clear that we are in an economic downturn. This is the period of the economy that ultimately gets dated as a recession later on by NBER. And this is the part of the economy that, when we were in our study last week, is this part here. When everything is actually contracting all together, right? When we see everything falling off a cliff at once, after this line right here at 0, that is where we are in this highlighted box here. And then all these aspects are the things leading into the recession, the slowing down of various parts of the economy, the peaks of various aspects of the economy. Those all come first. And so there's some things about this that really jump out, and they add some confluence to the study we've already done. So it begins with Fed tightening. That's usually the first part of the economic cycle from this particular lens. They begin tightening early on, and they usually tighten for a long period of time. They tighten for months, for years, and the economy rides up with them as they slowly raise interest rates until the point when it's just too much. So they raise rates, everything's going up, and then suddenly new orders peak, and then PMIs peak. And it makes sense that new orders would peak before PMIs because new orders bleed into the production of goods, right? As we talked about. So this makes sense. Housing also peaks early on, and then the yield curve inverts. And then a few other things begin to happen. Unemployment starts to pick up just a little bit off of its lows. It's not high yet, it's just coming off of the lows. Then we see things like the rolling EPS of the S&P, the earnings per share, that peaks. The market peaks. The Fed stops tightening. And then other aspects of the economy, they begin to peak out. Industrial production peaks. CPI peaks. New orders and PMIs go into contraction. Real sales begins to peak, and then the recession starts around the same time that the yield curve inversion ends, or just before it. As we studied last week, when we looked at things like real income, we noted that they can stay strong into the recession, right? It's not till later on in the recession when we really see employment falling off a lot, incomes falling off, consumption falling off. Well, I think that's interesting that the recession, the average start of the recession, is before the peak of real income. So that aligns with our data over here. Completely different data set, but aligning. Additionally, the high of unemployment is considerably later in the cycle, right? Unemployment begins rising early on before the recession starts, and then it continues to rise. And in fact, the recession ends before unemployment has done peaking. And that kind of aligns with what you see here, right? This is employment through the perspective that we used in the previous video. Here's the beginning of the recession, right where my red dot is, and you can see employment. This is not unemployment. This is people being employed. The growth rates beginning to drop off and fall below 0. This is people losing their jobs, and it kind of expands into the recession, right? It gets deeper into the recession. That aligns with unemployment peaking when the recession is done. It's actually at the end as the rest of the economy is beginning to kind of bottom out and start to expand again. So this is a fascinating view to me. And I think there's a lot of things you could really dive into here. You could look at individual relationships between some of these things across the eras and really just go nuts with it. But you guys know me, I like making visuals. And so I wanted to see what all of this looks like if I were to visualize it on a big graph together. And it looks like this. So each one of these colored squares is one of the recessions. You can see them all listed over here. The only one that's not listed is 1945 because it was a bit unique. It was at the end of World War II. We had low unemployment throughout. The Dow Jones rose the entire time, which is not like any of the other recessions. And it was really driven by a huge drop-off in government war spending. The public sector contracted dramatically and GDP fell like 11%. So the NBER called it a recession, but in almost no other way did it really look like a recession. So we leave that one out, but all the other ones are represented here. So this is a box and whisker plot, and it is showing the distribution of all of these recessions inside each one of these event buckets. And what you'll notice is that the cluster, the gray cluster, where the majority of the distribution is, they tend to distribute down and to the right, showing that there is a relationship, a kind of sequence to this, even though there is randomness inside of every era, even though none of them are exactly the same. And they all have their own unique footprint. There is like a framework, a skeleton key, if you will, to the way that this happens. Even though it's very different, there's a consistency, and you can see that in the distribution of these. And even if I I highlight different eras, like here's the Great Depression, you'll notice that the distribution of its events, occasionally one of them is out of order because, again, this is combining a lot of them. But generally speaking, it moves its way down and to the right as the days pass. Down here, the x-axis are days past. And that's pretty true for all of these. If you pick them, they tend to kind of drift down and to the right. And it's because there is a reliable sequence to many of these things. Not just because troughs come after peaks, but because the slowdown rolls through the economy in a pretty consistent way. So we've established that there is a pattern to this cycle. There is kind of a skeleton key framework that is relatively consistent across the eras, even if there are differences. We've established that the 3-month 10-year yield curve is inverted and it has a 100% accuracy. So that should give us some pause. That should put us on recession alert. Then we look over at the PMIs, which are currently below 47. They're in contraction. They're at 46.9 and they've just been going straight down. And we have observed that almost all the time that the PMIs are below 47 have been in recessions. There are some exceptions. There are a couple of soft landing scenarios. But when you combine the PMI being below 47 with the 3-month 10-year yield curve being inverted, that is kind of a 1-2 wombo combo of almost assuring that a recession is a high likelihood outcome for us. So then if we take this forward and say, okay, well, what is the current era telling us? How does it size up to these other events which appear to be relatively consistent? Is there anything that we can use to inform us about what's going on today if we assume that a recession is possible because of the yield curve and because of the PMIs and where they both are at the same time? So what this first column is showing is the amount of months between the market low and the yield curve inversion, the 3-month 10-year yield curve. And what you'll notice, assuming that October 13th is the low for our current era, which it is as of now. It's the low of the S&P. It is the only time in recorded history that the low of the market was before the yield curve inverted. The only time. It was half a month before the inversion of the yield curve. It was on October 13th, whereas the yield curve inverted on October 25th. In all other instances, including COVID, we were at least 10 months apart from when the yield curve inverted that we saw the low of the market. So if we were to project this forward 10 months, that would say the low should be in August. If we were to have the fastest trip in recorded history to a market low from the day that the yield curve inverted. So what this is telling me, friends, is that the low in October is not well defended. It's not well defended by historical context. If we have an inverted yield curve, which we very much do, if we have PMIs at 46.9, and that is only been something that happens in recessions. Down here, you're only seeing PMIs when they're at 47 or below. It lines up with these boxes with remarkable consistency. And then you're telling me the yield curve inverted 2 weeks apart from the low of the market for the first time in 100 years? You'd have to convince me that this time is different. And that is not a wise bet to make. So what you'll see here, the next column, just to kind of carry this exercise forward, this is called yield curve inversion progress. So this is, if we were to look at from when the yield curve inverts to when it re-steepens out of inversion, and we consider that a 0 to 100%. Where was the market low in that cycle there, right? From 0 to 100. And what you'll notice here is that not only does the market low come after the yield curve begins inverting, right? It's always after the start of inversion, with the exception of now, but it's almost when the yield curve is done being inverted completely. So 100% in the context of this metric would mean that the yield curve is no longer inverted, right? So right here, you see it goes red and it comes back to black. This moment right here, this is 100%. This is 0%. So the bottom of the market comes after the yield curve has dipped negative and then comes back up into positive. In almost all instances, virtually every one of these with two exceptions, 1974 and 1980. And both of those were almost at the end of the yield curve inversion. So what do these two tell us in concert? They are telling us the low of the market in virtually every instance instance comes after the yield curve has been inverted for at least 10 months, in most cases half a year or more. And not only after it inverts that it begins inverting, but in most cases, it's done being inverted completely. It's gone all the way down to hell and re-steepened. And it's come all the way back up into positivity in all of these instances except for two, in which case it was very close. So if we have all of that context in mind, and then we look at where the 3-month 10-year is, it's all the way down here. It is not re-steepening. It has all of this to go. It has to climb all the way back out. And so the argument that you would be making, if you were trying to present the argument today that the low of the market was in October, this is what you would have to be arguing. You would have to be arguing that for the first time in recorded history, we have a yield curve that is inverting, but we probably aren't going to have a recession. Not only that, but we have a market low that came in before the yield curve inverted, that the market is not going to go back down and set new lows, and that a recession is probably not going to happen. So you basically are presenting the argument that this time is different from every other time in recorded history. And that is a very difficult case to make because you do not have receipts. You do not have any evidence or context to back you up. Now, you could end up being correct just through happenstance, but it would not have been because your analysis told you that this time was different. In fact, the analysis strongly suggests that we are in the early innings of this saga and that the low of the market has not been established in any way at all. So I know I'm throwing a lot of data at you here, and maybe your eyes are glazing over, and maybe this isn't as interesting to you as you were hoping it would be. But for me, this is corroboration of a very sound argument that is very difficult to make considering where the stock market is today and what all of the bulls are talking about, right? Because when I look at this data, what I see is that we are in the very early stages of an economic downturn that has much further to go. We have a Fed that just began tightening a little over a year ago. The yield curve just inverted in October, and that is when the low of the market happened. And in every instance of the yield curve being inverted, going back a very long way, the low of the market was not for many more months afterwards. So when I see this little red print here in 100 years of data, it doesn't tell me that this time is different. In fact, it suggests to me that anyone who thinks this time is different is just really early and really wrong. Because when we look at the sequence of events here, it's remarkably consistent. And if we had to guess at where we are today, what have we already seen? We've seen a Fed tightening. We have new orders peaked. The housing permits have peaked. They peaked in December of 2021. The yield curve is inverted. Unemployment is at the lows. Perhaps it just recently rose. It's at 3.7%. The low was 3.4% just a couple of months ago. Rolling 12-month EPS for the S&P peaked in December of 2021. The high of the market so far was in January of last year. Industrial production peaked last year in September. CPI peaked last summer. We have new orders in contraction, and currently real sales have peaked. But what we don't have so far is an end to the tightening. We don't have an end to the yield curve inversion, and we don't yet have a bona fide start to the recession. Now, this won't be dated until much later, but as we've explored, there are things that we can notice, and some of those things have started to soften, right? The things that we noted get soft early. Well, when we look at where they are today, those are the three metrics currently printing a drawdown while none of the other ones are. So friends, if I had to guess where we are, I would say we are in inning 4 of a 9-inning baseball game, and that people who are expecting the low to be defended in October are betting on an historical anomaly that has no context, that currently has no receipts to justify that viewpoint. And if those people end up being correct, and this time we thread the needle, we avoid a recession, the economy continues to grow, CPI comes all the way back down to 2%, and then every one of these metrics turns around and begins climbing higher, and we leave all of this behind us, we will be assured that this time was different. It was different from every other instance for 100 years. But I can't take that bet. There's no way to make a risk-adjusted bet that this time is different. So when we have something with such high conviction like the yield curve, and it is deeply inverted, I have to feel like we just don't know what's about to happen, that we've still got many more months of this saga to go. And when we look at how many days it can take for some of these sagas, this can be a 5 or 7 year process. And we're really only about halfway through that when you think about it. Or maybe 2 years into this saga. If you think about it starting in the late part of 2021. I know everyone wants it to be over. Everyone wants it to be in the rearview mirror because we have AI hype. We've got the market pushing up into the retracement levels. But I'm sitting here looking at this data and I'm shaking my head. And I'm just saying, no, friends, no. We have considerably more to go through. So to kind of bring it all together, we looked at the yield curve. We've established it as 100% accurate, and it should give us a high alert signal for recession. We then established that manufacturing PMIs are below 47. That is a stone cold recession harbinger, and both of those happening at the same time gives it a near lock in terms of historical context. Nothing is guaranteed, but the odds are stacked in favor of recession. Then when we look at the timing of market lows relative to the yield curve, which is very reliable. The low of the market is usually not for 16 or 18 months after the yield curve inverts. Certainly not only 2 weeks apart, half a month apart. In every other instance, going back to the beginning of this series, it has been many months later, which suggests to me, if we were to project 18 months ahead of last October when the yield curve inverted, it suggests we may not see the low of this stock market until Q1 of 2024. And I don't think anyone is prepared for that. So that's really what I wanted to talk about today. There are some other data points that we need to discuss in the next video. We need to talk about current Fed policy and where that lines up with their economic projections. They've shown an unemployment rate that is very concerning for me. We'll talk about why that is in the next video. We'll also look at where the low of the market is in relation to the recession itself, and how long can a low in the past be defended by a recession downturn. In other words, when the market starts to crater, how far back in time does it take out old lows? We will look at that in the next video. I think there are some eye-opening discoveries in there that you won't want to miss, but we will save them because I don't want to overwhelm you with too much data. So, as I leave you today, and as you let all of this digest into your brain, keep this chart in mind here, keep this visual in mind. Keep in mind that we are somewhere in inning 4 of a 9-inning baseball game. The next step is for us to see something like the end of the tightening cycle. And perhaps we're there, friends. We're very close. We have an FOMC next week, and if we go look at the Fed Watch tool, which is positioning in Fed rate futures, the market currently expects the Fed to pause next week. There's a 70% likelihood, according to traders in futures, that the Fed is not going to raise interest rates next week. They may raise again in July, we'll just have to see, but next week is expected to be a pause, and that may very well signify the end of the tightening cycle. Make sure that you follow me on Twitter at TXMC Trades. You guys should know by now this is my main account. If you're not following me on here, what are you doing? Make sure you follow me. And we will save the last few tidbits for the next video. I've been teasing this out a little bit because there's a lot to talk about. There's still other aspects that we haven't even gotten into in these videos, and we may just unpack them as we move along into the future. But the next video I'm very much looking forward to because I want to show you guys a couple of really cool charts about the bottoms of the markets as it relate to recessions. I want to talk about the defense of old lows when the market turns down in a recession and all those kinds of things. So that's really the meat of what the next video will be about. If you have any questions or feedback for me today, make sure you leave it down below. I review all of the comments, and that's where we'll leave it today, friends. I hope you're having a good weekend. I certainly am. And we'll look to get another video out in the early part of next week. Until the next time, take care of yourselves, friends. Take care of each other, and we will speak on the other side. Cheers, everyone.